Hi again, this is Dave at AFX Search, licensed investigators in Palm Beach, Florida. Could it be possible that the victims of the $1.2 billion Scott Rothstein fraud are going to get back 100% of their money? How could this be happening? Look, we look at a lot of asset recovery cases on frauds. It's very rare that the percentage comes back that high, but it's usually because the asset recovery team that's working on it doesn't use all the methods associated with it. Recently this week, the judge that's working on the case for the Rothstein prosecution and bankruptcy announced that the combination of all the sources for the asset recovery may get back 100% or maybe even more of the funds necessary to make the victims whole and get full restitution. So let's take a look. They're using really good asset recovery techniques. You'll see a lot of these mentioned on our prior videos, but this researcher and recovery entity looks like they're doing a really good job, and hats off to them if this is true. So you're going to look at four things. First of all, the flow of funds. Look at where the money that went in from the investors, where it flows to. You'd be surprised how far that money has to go away from the fraudster for it to be out of reach for a clawback. If it goes to inside officers, if it goes to purchase assets, even if it goes to vendors within a certain period of time, that money may be subject to clawback. Remember too that a deposit of tainted funds into an account poisons all the rest, so that if a vendor takes in funds, or if an officer takes in funds, or even a related company takes funds, puts it in their account, even if it's only a few $1,000s, it may taint the rest of their money, the rest of their assets, make it all subject to clawback. It does not have to be the same money that comes back to victims. It can be other money that's commingled with the funds that are in question. Subsequent assets are also available for clawback. If that money was converted into boats, planes, cars, houses, jewelry, that can come back. In the Rothstein case, that's one of the famous examples. A lot of this money was used to buy jewelry. In some cases, that jewelry is clawed back from even third parties, and in some cases, even the jewelry store that sold the jewelry, watches, whatever it was, is liable to give back the money because they had some reasonable suspicion that this money was no good. So the flow of funds is the place to start. See where it went. Don't be afraid just because it's not owned by that fraudster or that creditor or the debtor anymore that it's out of reach. It has to go pretty far to get out of reach. Let a good asset recovery specialist work on that for you. Number two are third parties. Did anybody else benefit from this scheme? Banks, attorneys, title companies. It may be accountants. Did anybody have a benefit from this scheme? And more importantly, did they alter their normal course of business to accommodate this fraudster client? If a bank has a normal procedure of looking at checks if they're outside of a normal range, or if they have a normal procedure of making sure that there's signatures on corporate resolutions in order to process payments or to process transfers, if they did not do that in the case of the fraudster, just to benefit from a small amount of fees, they may be liable even in excess of what they earned. And the reason for that is through a theory of engaging the fraud or enabling the fraud, or in some cases extending the loss. If the fraud already existed but it was allowed to go farther and extend because a bank did not do their normal due diligence they do on every other customer, they may be liable for the victims' losses. And in the case of Rothstein, TD Bank had a $72 million judgment against them they have to pay, even though they didn't make that much money on the deal. And that gets into the number four, which is aggressive negotiations. We'll get to that in a minute. Number three, however, is co-conspirators. Are there other people involved with the fraud? Maybe not the principals, maybe related companies, maybe employees. It could also be relatives who had some of the involvement in the fraud itself. Duplicate that same process with them. Look at the flow of funds to them, look at their third parties, and see if those are ripe for recovery. And number four is aggressive negotiations. In the case of TD Bank with Rothstein, look, this is a bank that did not want to get dragged into the mud with this fraud case. They're growing in South Florida. I think last week they opened 6 new banks, so they don't want to be tainted with this case dragging out forever. So aggressive negotiations with these third parties and with anybody who is involved with this where the money flowed through is a good source for getting recovery from that person or their insurer. A lot of times, if you make sure that the entity you're checking into puts their liability insurer on notice, that insurance company is going to get involved. The company can't hide it or try to negotiate themselves and say, no, we're not giving you anything. Once the insurer is involved, a lot of times they're going to want to settle it so that they don't have a larger claim later. Remember, most of these professional companies, they don't want to be involved with these kind of tainted processes. They have employees, clients, lenders, regulators that they don't want to have problems with being involved with a fraud, like in the case of Rothstein. So there's many avenues for collecting all this money. Some of it comes from the actual assets of the fraudster, but you don't want to stop there. You want to look at all these things. You want to push lightly first on all these different areas, increase your expectations of what you're going to get, identify these players to start with, push lightly on their bank accounts, push lightly on their assets to see what gives. Look, these third parties can't play dumb. The bank may say we didn't know what was going on, but when you can prove that the pattern of activities did not match a normal business in that same arena with the same amounts of money flowing through, same number of transactions, it's hard for them to say that they didn't know it or that they shouldn't have known it ahead of time. Third-party recovery, flow of funds. In these asset cases, we hate to see how many of them go where the victims don't get all or most of their money back. The money has to go somewhere. One thing about money, it doesn't disappear. It doesn't evaporate. It doesn't go to zero. It went somewhere. Following where it went is the first step in getting it back for the victims.